Welcome to the Allan Small Financial Show. Once again, I'd like to thank everyone for taking the time out of your busy day to spend it with us. I think if you're an investor today and you're in a growth mode and you're trying to grow your portfolio, I'm pretty sure most of you would be happy over the results over the past, well, let's call it since the beginning of this year and even last year. The markets have been on a tremendous run. We're going to chat a bit about that today. I know a lot of you have questions as to should you be putting more money to work? How long can this rally last? We're going to talk and answer. We're going to speak about and answer a lot of those questions on our show today. And as always, we always want to get to as many questions, as many topics that I've been hearing about, topics that individual investors have brought forward to me over the past couple of weeks since our last show. We always want to bring you the answers on our show today. So let's put up our topics for today's show. There they are. So we're going to start with Fed speak. And the Federal Reserve is actually up on Capitol Hill right now as we have this show, talking to the House of Representatives. Yesterday, he talked to the Senate Banking Committee. And the Fed has also given us, or we've learned some of the minutes that were taken over the last Federal Reserve meeting. I guess not too long ago, we heard or we read about the minutes, what was discussed in those meetings, in the Fed meetings. And we're going to talk about and chat a bit about that today. As always, our top 3 things to consider over the next 10 business days. These are things that individual investors should be considering before you make your investment decisions. Managing expectations. This is something that I think all investment advisors struggle with from time to time. What are the correct expectations that an individual investor should have right now with respect to their portfolios? We'll talk about managing those expectations and the markets going forward. Has NVIDIA peaked or just hit a bump in the road? We're noticing that NVIDIA, really since it's hit as high of about $140 a share after they split most recently. In the last couple of days, we've seen NVIDIA go back above $130 a share, but NVIDIA at one point dropped about 15% in share price down to 117, 118. And so maybe some individual investors might have been a little bit nervous, but is this just a bump in the road? And are we going to see bigger and better things going forward? We'll talk about that. Retirement planning and worries of outliving one's savings. As the population continues to age, baby boomers are now in that retirement stage of life. I'm getting a lot of questions about, am I going to outlive my money, Allan? Do I have enough money to retire and to live the lifestyle in retirement that I want to lead? How do I know? That's a question that people obviously have quite frequently. That's a worry, something that keeps many people up at night. So we'll talk about that. And our most recent addition to our show, Quick Hits. We have 3 topics today that I'm sure many of you have been talking about, seeing things on social media. One of them in particular, which is the debate we saw with the 2 presidential candidates. So definitely one of our quick hits is about the upcoming U.S. elections. So we'll touch on 3 things there that people are seeing in the news. And lastly, I'll try and get to as many questions as I can, your questions. And if you have any questions, please put them in the chat box during the show. I received many, many questions, which is great during, I guess, the 2 weeks in between shows, which is fantastic. Many comments on YouTube. Keep them coming. Love to hear from all of you. Love to hear what you think of the show, any future topics that you would want to hear about or me speak about, any questions. Love to hear them, love to read them. So please keep them coming. They're probably my favorite part of the show. So without further ado, let's move on to topic number 1. Fed speak. It's something that we talk about all the time. We don't really talk about much, unfortunately, Bank of Canada speak, because it's usually the Federal Reserve and what they say that controls the markets in the United States and the markets here in Canada, the Toronto stock market as well. And really, for the most part, what the Federal Reserve has said, the head of the Fed, Jerome Powell, has said over the past, well, let's call it many months now, is that, yes, inflation is heading in the right direction. It is moving down, but they need to see more data to back it up. Is what the Fed's seeing right now transient, meaning temporary? We saw inflation coming down towards the end of 2023, only to pick back up again in the first quarter of 2024 in the US, kind of got the Fed a little bit concerned. And now in the second quarter, we've seen it come back down once again. So the Fed is going to be extra cautious as to the data that they want to see, the amount of data they want to see before they consider making an interest rate decrease. We've already seen a decrease in rates here in Canada, and the question now becomes, will we see another one in July? So will we see back-to-back interest rate decreases by the Bank of Canada, whereas the Fed still on the sidelines? Some are predicting maybe a cut as early as September. Many others or many more, I should say, are predicting an interest rate cut not until December. But what's interesting about the Federal Reserve, and I think based on their testimony up to the Senate Banking Committee and what they were saying coming out of the recent minutes, I find a little bit different, a little bit interesting, taking more of a dovish tone by the Fed. You see, the Federal Reserve has two mandates: price stability, which is what we've been focused on, which is bringing down inflation. And their second mandate is full employment. When we start to see the unemployment numbers start to creep up, when we start to see the jobs growth start to slow, this can become a concern of the Fed. And in their most recent commentary, they noted this. We've seen the unemployment rate go up from as low as 3.3% not too long ago, now to above 4%. We've seen, the amount of job openings start to fall substantially over the past few quarters as well. So we're starting to see a softness in jobs. And if that were to happen, or that were to continue, perhaps that would give the Federal Reserve the opening to start lowering rates, not because necessarily inflation is at a 2%, their 2% target, but because of their second mandate, that unemployment is starting to tick higher, and they don't want to see unemployment get out of hand. They want to see continuous job growth. So if we were to see a continued slowdown in jobs and job creation, perhaps we can see, or we will see, an interest rate cut sooner than we are anticipating right now. You couple jobs slow down, or jobs growth slow down, or the rate of change slowing, with a services number that we received recently. The industry of supply management services was actually in contraction mode, which is interesting because services has been in the United States where the inflation has been most sticky. So service industry, restaurants, and retail, we actually saw contraction in the most recent number out of the United States, which is something we have not seen in quite some time. So we're seeing a slowdown in growth, GDP, slowdown in jobs creation, slowdown in retail sales for the month of May was just above the flat line, slowdown in services, slowdown right across the board. And many are starting to believe that perhaps an interest rate cut may not be, or we may not have to wait until December. One may come sooner. So I have a first chart here that, as always, would like to show everybody. And it's our first chart, job search of 15 weeks or more. And this shows you that people are starting to, or more people are starting to search for jobs. More and more people are starting to search for jobs or employment. Again, something that the Fed will be watching because of that second part of their mandate, which is full employment. The second chart I have here, which clearly shows the unemployment rate in the US, definitely moving higher. You can see on the far left, it actually was slightly below 3.5%, now above 4% on the right-hand side. So definitely going from the bottom right from the bottom left to the top right, something that we don't want to see. We love to see that when we look at charts for stocks, but definitely not something we want to look at when we look at the unemployment rate. The next chart I have is a bar graph or bar chart, and it shows that in the month of June, we grew jobs, or sorry, I should say the United States grew jobs, 206,000 jobs created, a good number, roughly what was expected, approximately what was expected, down from, and I see here it says 218, but should be actually closer to 270,000 jobs were created in May. in the United States, a big pullback down to 206. Perhaps the 218 actually takes into account some of the revisions that came out after the fact. So we did see 272 in May revised downward. Perhaps that's what that bar chart is showing. So I'm going to take it at that. 218 was after the revisions, and now we're seeing 206 for the month of June. If we get revisions to the month of June, when we get the July data, then that could come down as well. So definitely seeing a slowdown in jobs. Job openings, our next chart, as I said earlier, this number once upon a time was in that 8-9 million range, and now we're seeing quite a big dip in job openings, and the percentages you can see coming down. Percentage of job openings definitely coming down over time. Last but not least, when you couple the slowdown in jobs, as I said, with a slowdown in growth, with a slowdown in services, you're seeing a lot of a slowdown in many areas. It's no coincidence that you're seeing an increase in the amount of, I guess, money or debt that people are putting on their credit cards. And our last chart here definitely can show you that. You're seeing total credit card debt in the US. Look how much that has spiked in the past few years. Definitely gone up by quite a bit in the last few years. I think a number that the Fed has to be looking at. We know that they, unfortunately, don't look at the consumer numbers that closely. Their mandate, again, is jobs and price stability. But this all plays a part. When you have a slowdown in the economy, a slowdown in jobs, a slowdown in growth in general, unfortunately, for individuals, you're going to see a pickup in debt, pickup in terms of how much money people have on their credit cards. And it's just no wonder that we're seeing that. So overall, I think we need to definitely pay attention to what the Fed is saying. We need to continue to take a look at this data and be mindful of what Jerome Powell and the other Federal Reserve governors are saying, so that we can continue to get a better picture as to how the U.S. economy is faring and what the Fed is thinking and how soon we may get that first interest rate cut. Now the part of the show that we have on a regular basis, I think it's a highlight for many. And these are three things that I think individual investors should focus on or consider before you make your investment decisions over the next couple of weeks. You can see here our number one topic today, U.S. bank earnings, big bank earnings out of the U.S. They're coming out at the end of this week, Friday. We're going to hear from three of the biggest banks in the United States, Citibank, Wells Fargo, JP Morgan. The only big bank really not there is Bank of America, which I believe comes out with earnings early next week, followed by Goldman Sachs and Morgan Stanley. So we're going to get a pretty good picture as to how the United States is faring when we get U.S. Big bank earnings this week. Second point, I think individual investors should keep an eye on or focus on is economic data. And when I say economic data this time, I mean pretty much one data point, and that is CPI, Consumer Price Index. We're going to get CPI numbers out of the U.S. tomorrow. And what is the CPI number going to look like? Well, we've seen PCE, which is another measure of inflation, coming in at around 2.6%. So getting close to the Fed's target range and falling back a little bit. What is CPI going to say, right? Most recent numbers have CPI above 3%. Can we get CPI back to where it was at the start of the year, which was in and around 3%? And actually below? I think that would be fantastic. And our third point, last point to discuss today, should investors still buy into this market at current highs? A question I've been getting a lot of, especially as the market continues to make new highs on a regular basis. So let's delve into the first point, U.S. big bank earnings. And as I said, the big banks give us a pretty good indication as to how the economy is faring. They're the bloodline of the U.S. economy. Banks are usually, the big banks are the bloodline of any economy. And we just went through what we have, which is what we see as a one-time or an annual stress test. The Federal Reserve puts the big banks. I think last year was 23 banks in the U.S., the 23 largest banks. This year, as many as I believe 31 banks met the criteria to go under or go through this stress test. And what the Fed does is it increases the unemployment rate dramatically. It increases interest rates dramatically. It paints a very bleak and very difficult scenario for the banks. And then it says, do the banks have enough capital to be able to withstand or weather these harsh conditions? And we found out that all the banks, I believe it was, I think 30 or 31 banks, passed the stress test and they were all fine, which is great to hear. In past years, we always found that maybe one or two did not pass and had to do certain things to raise capital and do other things to get a passing grade from the Fed. This year, they all passed. And once they all pass, what does that do? Well, it gives them a green light to be able to do things such as buy back their own shares or increase dividends. And we're going to get into that shortly, but many of them, actually all of them, all the big banks, I think the 15 largest banks actually raised their dividends. Some of them small, some of them larger. But overall, the banks are going to report earnings starting off this Friday. And it's interesting to note, if you compare the banks, and I'm expecting some good numbers, by the way, I'm expecting some really good numbers to come out. But if you compare the banks and the bank earnings as to what we're expecting to other sectors of the U.S. economy and the S&P 500 in general, you'll find that the expectation is actually below what we're expecting for the S&P in general. And our first chart shows this. And if you look here, U.S. banks kick off earnings season, which is our first chart. And you can see here that financials, which is in the bright color, comes in below what we're actually expecting overall for the S&P 500. We're expecting earnings growth of 10.5%, S&P 500, and the financials are actually under 9%. Largest, growth, or the most growth we're expecting is out of the communications area, over 21%, info technology, 17%, and healthcare. Actually, a strange one to see because we know healthcare stocks, some of them have done extremely well, like the Eli Lillys of the world, Novo Nordisk, with their weight loss drugs. But many pharma companies haven't done nearly as well as those two, obviously. And many pharma companies have been struggling. So it's interesting to see that healthcare is one of the sectors predicted to do really well, 20% growth rate. So when you look at financials, I am expecting some good data, some good numbers out of the banks. A lot of the banks are at 52-week highs. Some of the banks like JP Morgan, Goldman Sachs at all-time highs. But I think you can still take a look at some of these banks because I still believe they are relatively cheap. The next chart we'll show here. This will show us all the different dividends and the dividend increases. And you can see here at the top of the list, I know the numbers are small, but I can read you some of them. JP Morgan, first quarter dividend going from $1.15 to $1.25. Bank of America raising their dividend by a couple of cents. Here we have Wells Fargo going from 35 cents to 40 cents. You can see here Goldman Sachs raising their dividend $2.75 to $3. So all, or pretty much all the big banks raising their dividends by a few pennies, a certain percentage. And that, obviously, if you're an investor, is a fantastic recipe for success. So as we look towards the big bank earnings out of the U.S., I think individual investors need to focus on that. It definitely should be an area that investors have in their portfolio, Canadian bank stocks and U.S. bank stocks. We won't get Canadian bank stocks really until end of August or so. But until then, I think the focus definitely should be on U.S. bank stocks. Second point I wanted individual investors to focus on is the upcoming economic data out of the U.S., which is CPI, Consumer Price Index data. And that will give us a good indication as to where inflation sits. And difference between, as I say often, between the PCE data that we get out of the Fed and the CPI, sorry, not out of the Fed, but that we get out of the United States, and the CPI data is real estate. CPI actually has a larger real estate component to the number than the PCE. And I think that's why the Fed likes the PCE number a lot better. But CPI going to be released tomorrow morning. And what is it going to tell us? Is it going to give us a number closer to 3%, or is it going to be status quo? Our first chart that we have here is, or shows you where CPI is right now. You can see there it is, core CPI 3.4%. The headline number 3.3%, down a little bit from over the last couple of months. So that's a good sign that we are starting to see CPI fall. Our next chart here, which is one that we continue to see, and it really doesn't change, which is the point of putting it up. We see a flat line on the far right-hand side. Interest rates haven't gone up, but obviously they haven't gone down recently. So we have a big spike up followed by a flat line, and that is the Federal Reserve keeping interest rates as is. Compare that to Bank of Canada, which is our next chart. And again, you could see a flat line, but then you see a little tick lower on the far right-hand side of this chart, showing the first interest rate decrease in Canada to 4.75, our inflation rate 2.9%. So again, pretty big gap, just like in the US. There's that big gap between 5.5 and 3.3. We're seeing 4.75 and 2.9. So overall, the CPI number tomorrow morning is going to be a market mover, and it obviously will depend on the components of the CPI, where we see the inflation numbers, but it's definitely something that individual investors need to pay attention to. Our third topic and last topic for this segment is the whole idea or question: should investors continue to invest when the markets are making all-time highs on a daily basis? And that's a tough question, because we're all taught to buy low and sell high. Well, here we are. Anyone who buys in now is buying high to hopefully sell higher, perhaps. That is the goal, because we know that markets move higher over time. If you look back 5 years ago, what the highs of the markets were, you could say the same thing. Well, maybe we shouldn't buy. But then here we are 5 years later, the markets are significantly higher than they were 5 years ago. Markets are significantly higher than they were 1 year ago, 6 months ago. So it's not necessarily a good idea not to buy into the markets just because they're making highs and you'll be buying at a high point, because as we note many times, today's high point could be the lower point over the next 6 months. So you never really can tell where the market's going, and it's very important to keep that in mind. The first chart I want to show about this is just a simple chart of the S&P 500 over the past year. And really, you can see that the market is at an all-time high. We coming off of the blip in April, where we saw the markets pull back 5-6%, a healthy correction, as I like to say, and the market really hasn't looked back since then. One of the things I wanted to mention regarding buying at the current highs is that even though the market is at an all-time high in the US, and we're trying to get back to all-time highs here in Toronto, we're just slightly off. The market is moving not because we're seeing widespread gains on the index. The indices are moving higher and making all-time highs because of one area in particular, and that's technology, the big cap tech names. So what does that mean? Well, that means that even though the markets are at all-time highs, there are still many companies that are nowhere near their all-time highs. The 7 largest companies, or the Mag 7, or Magnificent 7, as we known to call them, back including Tesla again, because Tesla's been on a tremendous run. Those stocks have been doing extremely well as compared to the other 493 stocks on the S&P 500, which have not done nearly as well. So even though the markets are at all-time highs, and that might give you, a little bit of a pause there if you want to invest, you shouldn't be pausing, because there are 493 stocks that are still not at their highs, or many of those 493 stocks that are still not at their highs. The next chart clearly shows this, narrowing the gap, or the earnings gap, and that's what we want to see. We want to see a narrowing of the earnings gap between the Magnificent 7, which is the brown line, or the brown bars there. The gray is the S&P 500 in general, and then the S&P 500 X Mag 7, so 493 stocks. You can see the orange, how much it's underperformed the S&P and obviously the Magnificent 7. So maybe if we focus on some of the good quality names in the orange area, the 493 stocks, not the Mag 7, then I think there are a lot of good quality names to buy into, even though this market is at an all-time high. So looking back at the question, should we be investing even though the market is at an all-time high, putting new money to work? The answer is yes. I would be looking to put money to work. You never want to time markets. You want to buy good quality names. And I think you can even look at some of the Magnificent 7 names, some of the cheaper names out of the 7 to add money to, because I think if you're looking for growth, I think you still need to own some of those big cap tech names, But overall, even though the market is at all-time highs, I still think you want to put money to work if you have the ability to do so. Managing expectations. And this is something, as I said off the top of the show, something I try to do on a regular basis. If an investor has an expectation of making a certain amount of money or having certain types of protections regarding their portfolios, and your portfolio is designed not to earn you a certain growth rate or not to have those protections, then there is I guess, miscommunication between the advisor and what the individual investor is anticipating from their portfolio, the outcome or the growth rate, or what their goals are, or what their goals are looking, or what they're looking to obtain from their portfolio. And managing expectations is extremely important in that respect, that you talk to the individual investor, that I talk to the individual investor to make sure that we're on the same page. And that is what I spend much of my time doing, talking to individual investors, making sure that they have the right expectation for the portfolio that I have designed for them. And that is really, or shouldn't be any different than any investment advisor. But managing expectations even goes further than that. Our first chart here that we can put up is the business cycle. And I've shown this chart or this picture before. It's been a while since I've shown it. And it talks about expansion. Then you go through a peak, and then you have depression and trough and recovery, back to peak, back to recession. And it's this nice smooth curve. Well, I can tell you first, the economic cycle definitely does not look like that. You never have an exact curve, an exact smooth curve. You'll have many ups and downs within the peak, within the expansionary part of the cycle, within the trough part of the cycle. So it doesn't really look like that. But it definitely, the areas that are highlighted, peak, expansion, recession, recovery, those are definitely important areas or headlines to note. Now, I'm not here to say that, well, where we're at today is a peak and we should be mindful that we're going into a recession. We could stay at these peak levels, and really that's where we're at, right? Where markets are at high points right now. We could possibly stay in that peak range for quite some time, taking it gradually, taking it slowly, allowing for the other 493 stocks, as I just said in the previous segment, to catch up and get involved in the growth, the coming out of where we've seen with the tech stocks and how much they've dominated. It's time to see some of the other sectors get involved with the cycle here. And investors, I think, as I said in the previous segment, I think you can be an investor today, even though we might be at a temporary peak and maybe make new highs on a regular basis, which we've been doing for the first, let's call it 6 out of the first 7 months of the year, 5 of the first 6 months of the year. I think that the cycle of emotions, as we call them, is valid. But I think that based on what has been happening, we could stay in the range we're in right now for still quite some time. But we could hit a bit of a correction maybe in the coming months. And that's what I wanted to talk about as well. The fact that you need to have the right expectation. And I have another chart of the S&P 500, which we can throw up on our screen here. And I wanted to show this because it's important. Last time we saw a pullback in the markets was April. And that was about 5 to 7% pullback. Let's call it 5 to 10%. Keep it a good number. Time before that we saw markets at low points or pulling back was last October. So really, since last October, if you take away that one and started as of November 1st, we've only seen one correction. But we know corrections are healthy, and we see corrections all the time. I had an email from a client recently talking about how maybe we should sell at some point at the end of July and kind of keep some money in cash to wait for this correction, to then buy back in and then ride the wave higher at the end of the year. In theory, maybe that works, but you never know. I've seen markets go up in September and down in November. I've seen markets go down in July and higher in October. It is not an exact science. Historically, we can look at numbers, we can look at averages, but overall, we don't ever know, and it's very hard to predict what the market's going to do, what investors are going to focus on, how high the market can go before we see that correction. So having the right expectations, in my opinion, are very simple. You want to, if you have a growth goal, or your goals for your portfolio are growth oriented, you want to stay in growth, but you want to continue to move money around, maybe trim some of the profits, maybe buy some undervalued names, continue to move money around within the portfolio itself, because you never know when the next pullback in the market is going to take place. It is healthy that we have these pullbacks, and as long as you have the right expectation and expect to see pullbacks and understand that they are healthy, I think you're going to be just fine. And I think that owning a good quality portfolio, owning good quality names that hopefully even pay you some good dividends, that has always been the recipe for success. And even when we're expecting at some point a correction or a pullback in the market to happen, I just don't think you go out and panic and sell and try and get ahead of it, because you just never know when that is going to happen. So why do we talk about NVIDIA so often? Well, as I've said on other shows, NVIDIA is the largest chip creator, maker for artificial intelligence. At one point earlier, I guess not too long ago now, this year, it was the largest company in the world temporarily, and then Microsoft passed it. And now, interesting enough, Apple is now the largest company once again. And many are actually talking about Apple being the first $4 trillion company with a $4 trillion market cap. The $1 trillion trio is that I always say, or the $3 trillion trio: NVIDIA, Microsoft, and Apple, biggest companies in the world today. So it's no wonder that we talk about NVIDIA as often as we have. And we also know that NVIDIA has made up, at one point this year, a third of the growth, 1/3 of the S&P 500 growth. Unbelievable how much NVIDIA, how well NVIDIA has done and how much of the growth it currently makes up. However, we've seen NVIDIA pull back recently. After it split, NVIDIA hit a high of around $140 a share, and it pulled back all the way to about 115, 118. Is that surprising to see? In my opinion, no. Investors taking some profit off the table. You can never go wrong taking profit off the table. Our first chart here will clearly show how NVIDIA has fared over the past, let's call it, month or so, hitting that high 140, pulling back to 118. And now you can see on the far right-hand side of this chart, NVIDIA is starting to surge once again. Why is it surging? Because many analysts have now taken up their expectations for the stock to 150, 160, $160 a share. So when analysts start taking up their expectations, individual investors start to get excited again. They start to say, hey, if I got $20, $30 worth of growth on $120, $130 stock, that's a pretty good rate of return. And then people start to buy, driving up the price once again. But even though NVIDIA had a bit of a rough go, dropped 15% from, let's say, mid-June to recently, the stock market was still making all-time highs. And one of the things I wanted one of the points I wanted to bring out is we started to see other companies pick up the slack for NVIDIA. One of the names that I wanted to show is AMD, and we have a chart on AMD. Today, I can tell you AMD has actually gone over $180 a share, $176 a share here. And you can see here on the chart on the far right-hand side how much AMD has surged, pulled back from their high of about $227 not that long ago, back in, I guess it was back in March, pulled back in over May and June, and now it's surging once again. Hopefully, it can get back to that $200 price point and beyond. So AMD, another large chip maker, in the areas of PCs, AI, automotive, lots of different areas that AMD makes chips for, and they've definitely picked up the slack while NVIDIA had slowed down. Intel, a name that we don't talk about quite often, and a name that I've talked about, unfortunately, on the negative side of things. Even Intel has picked up the slack a little bit, going from, let's call it, the high 20s, maybe $30 a share, into the mid 30s recently. A lot of people buying Intel, thinking that it is extremely cheap. Intel, as many of you will recognize the name, has been one of the largest chip makers in the world for many, many years. And it wasn't until the last maybe 5 to 7 years has Intel kind of fallen off a little bit. NVIDIA has surpassed them. AMD has taken a lot of their business away from them. So Intel is struggling right now, but their share price has definitely not struggled in the last little bit. And the third chart I wanted to show regarding stocks that have picked up the slack for NVIDIA. And this is the largest company in the world right now. This is Apple. And let's take a look at their chart. Wow, what a chart. $230 a share. I think it's a little bit above that now. And definitely the largest company in the world, definitely picking up the slack for a bit of a pause, let's say, in NVIDIA. So is NVIDIA, should we be selling our shares, or is this the pause that refreshes? I think if you ask most analysts, they're going to tell you that this is the pause that refreshes, and that based on what analysts are saying, based on their channel checks, on how much NVIDIA is selling, based on the spending of companies like Amazon and Microsoft and Meta, and Apple, etc., based on a lot of these big tech names spending billions in artificial intelligence, I don't think NVIDIA is going to slow down anytime soon. The question then just becomes, can it keep up its rate of growth? If it can't, and if it does pull back a little bit from growing 200% every quarter to maybe just growing 100, 150%, we could see a bit of a pullback, even though the numbers would look fantastic. But I still maintain that it is a bump in the road and that we will see higher numbers down the road. I think you can take some profit off the table in NVIDIA, but I still think you want to be a holder of their shares going forward over the long term. Retirement planning. Now, this is something that everybody, I guess, at some point in time starts to become concerned with, or basically just wants to know, do I have enough money to live the lifestyle I want to live once I stop working? Life expectancy is definitely getting older. People are living longer now than they were, 20, 30 years ago. And so people are nervous. Do they have enough money to retire on and be able to enjoy life in retirement? And again, as I said earlier, with the population aging here, Canada, places like Japan, even the United States, people are wondering, do they have enough money to retire on? And first chart we have here just shows us very simply the life expectancy. And you can see here, the top line, probably the most important line, you can see a Canadian life expectancy from 1950 to 2024. And it is a steady climb, bottom left to the top right. People simply are living longer. I think a lot of that has to do with some of the rules that have been put in place. For example, you can't smoke in many of the buildings, if not all the buildings here in Canada. And I think when people stop smoking or not being able to smoke inside, I think that stopped many people from smoking. And as we know, cancer, when you smoke, obviously one of the causes of lung cancer. And I think that has really helped the average life expectancy, people living longer. And I think that has really helped. Be interesting to see or compare Canadian and maybe US to maybe some other countries where they don't have the same rules. But obviously, people are living longer and therefore more concerned that maybe their money or maybe their money won't last longer. So that's a concern. But I think the main part here that anyone who's watching today, what the main part I wanted to get across, the main point I wanted to get across are the questions that you should be asking yourselves, you should be asking your investment advisor. And these are the questions that I ask my clients for, or to get the answers for when I make a retirement plan, when I run some of the data, some of the information through our software, and then the software spits out to us the retirement plan and gives us all the numbers. What is some of the data that I plug in? Well, we have our next chart here that goes through some of the questions and some of the points that I talk about. First one, life expectancy. Most people will say, well, Alan, run the data or run the numbers till age 85. And that's approximately today what life expectancy is for people living in Canada. But some may say 80, some may say 90 if they have longevity in their family. So what I guess, age do you want us to run this scenario out to? Inflation rate, as we know, is extremely important. If we did some reports with current inflation rate or the inflation rate over the last couple of years, it would have been pretty high. But we tend to use 2.5% inflation rate. We don't want to use a 2% rate. Maybe 3 is a little on the high side. Maybe 2.5 is about right. Rate of return on your investments is extremely important, because if you have let's take a $50,000, $100,000 portfolio and you want to pull out a certain amount of money per year, but how much are you pulling out as a percentage? And if you're making a good rate of return, obviously you'll be able to make back some of the money that you're pulling out, and hopefully you can live off of the growth and not touch the capital original principal. So rate of return on your investments. Now, you can calculate a current rate of return that you're getting, the average rate of return, and use that. Or for some people, you may want to take a conservative rate of return. Right now, low risk investments are probably paying in that 4.75, 5% range. Maybe you want to use that. Maybe you want to use a conservative growth rate of 7 or 8%. So right now, medium risk is probably earning close to 10, maybe 10 to 12%. So you need to choose a rate of return that is comfortable for the person, for the investor, and that should go along with the type of investing and the type of products they have in their portfolio. When does a person want to retire? What age? It's obviously important, because that's the age that you stop probably contributing to your plan and start to pull money out of your investment plan. CPP and OAS, do you qualify for OAS? Would you have some of your old age security clawed back because your income is too high? CPP we all get if we pay into it. So have you paid into CPP over the years? And what are you getting from that? We should factor that in as well. And lastly, when does a person want to begin to withdraw? As I said, most people, when they retire, they start to withdraw money. But for some, they have built up a nice nest egg, and they may not need to withdraw money right away the day after they stop working. They may have enough money to last them maybe a year or two before they start eating into or pulling out money from their RSPs and investments. So all these factors, or all these things, will play a factor in building out a plan, in a retirement plan, to give individual investors that peace of mind, and knowing that, yes, I'm in a good spot. I have enough money here to retire. And as you can see, I didn't even factor in things such as your home, which is a big part for many people. Downsizing their home, getting the money that after the sale of their home, moving into something a little bit cheaper, and then taking the difference and either investing it or using that in some capacity to live off of. So a lot of things go into that retirement plan, or that planning. And so how do you know if you have enough to retire on and live off of? I think you need to go through this exercise. And that's something I do quite often for individual investors, and I can do for all of you. Quick hits. This is a part of the show that we've added recently. These are 3 things that you're probably seeing in the news right now. Wanted to just comment on them very briefly. U.S. election drama. I'm pretty sure everybody has heard or saw the debate between former President Trump and current President Biden, and all that came out of that, and did that affect the stock markets? Well, I'll talk a bit about that very briefly. Canadian dollar. Some of you may notice that Canadian dollar is actually nudging higher. Why is that happening? And last but not least, experts are starting to debate whether all this spending on AI is giving them a return on their investment, or are they going to have to wait quite a while? So some are starting to, question all this AI spending. So let's touch on the first one. The U.S. election, upcoming election in November, very, very important for everybody, even though we live here in Canada. Very important for Canadians, because depending on who wins, they're going to, looks like, implement perhaps some new taxes, or in the case of former President Trump, maybe cut taxes. There could be some tariffs put on goods coming into the United States. So all the controversy based on the recent debate, all the talk coming out of that, Democrats, perhaps some of them wanting President Biden to step down and not run in the next election. But he looks like he's going to run, and he has all intentions to run, but we'll have to see what happens. Markets probably not fluctuating an awful lot, although I will say that all this talk about the former President Trump winning the next election based on the outcome of the current or the most recent debate and other polls that have been taken. Market actually likes that, because anytime you cut taxes, which is what former President Trump is saying they're going to do, reduce the red tape, that only can help the stock market. So I would say the debate, all the talk we've heard recently about President Biden and his re-election ambitions, not having too much of an effect on the stock market, but definitely we're going to keep track of that. Canadian dollar nudging up a little bit. That's the second. And I think my comment there pretty much is it's based on what's going on with the US dollar. So it sounds like the Fed may cut rates more than once this year, and maybe as early as September, as I said earlier on the show. Probably a coin toss whether they do it or not. However, if they were to cut rates, you probably would see a surge in our dollar. And if they don't cut rates, you probably see our dollar pull back and the US dollar move higher. So I think what the Fed does and says probably has more effect on the Canadian dollar than what the Bank of Canada does. Although I will say, if the Bank of Canada cuts a couple of more times before the Fed does, you will definitely see our dollar fall back towards that 71-cent range. We actually have a quick chart on that we could show on the spot price of our dollar. There it is, 73 cents approximately. And you can see how much our dollar has gone down. Although if you look at the far right-hand side of the chart, you would see our dollar definitely has been nudging higher. Our last quick hit point that I wanted to make is regarding artificial intelligence. What is the actual rate of return or on artificial intelligence spending? What's the return on investment? Are companies actually seeing a return on investment for all this spending? I'm going to probably say the answer is probably not. I'm sure they're getting a lot of returns from their artificial intelligence spending. I'm sure it is making their businesses a lot more efficient. But I have to say that maybe a year from now, I am confident to say that they're going to experience a much higher rate of return from artificial intelligence spending, or their ROI is going to be much better a year from now, a couple of years from now. I truly believe that we are only in the early innings, using the baseball analogy, of artificial intelligence and the implementation of artificial intelligence in all businesses, right across all sectors of the economy. So if you're looking at, ROI, return on investment with respect to artificial intelligence, and if you were to kind of be a little bit negative on artificial intelligence because of that, I think that's a mistake. I think you have to look at it to the future as artificial intelligence being that one thing to change the way we live, to change the way we do business, to change our lives as a whole. So don't necessarily get boggled down on the ROI regarding artificial intelligence. If you hear people speaking about it, I would take it with a grain of salt, knowing that artificial intelligence is here to stay, and it will continue to revolutionize the way we live for many quarters and many years to come. Now the part of the show that, as I always say, I like best, where I can manage to take one question from the audience, and then over the next couple of weeks answer some of the others that I've received. And looking today here, here's one question. Hi, Allan. Am I better to put a down payment on a house, pay off my student debt, start investing in the stock market? Do you ever help clients make these decisions? I guess the simple answer and the quickest answer is to say yes. I help investors make those decisions all the time. And whether or not you pay off debt, or you invest in the markets, pay off your student debt, or maybe put a payment on a down payment on a house, really always comes down to one thing, and that's interest rates. What is the interest rate you're getting on the money you're borrowing to buy the house? Your mortgage rate. What is the interest rate you're paying on your credit card debt, your student debt? What are the rates of return you're expecting to achieve if you invest in the stock market? And if the answer is the interest rates are extremely high, then yes, maybe you want to start looking at paying down some of that debt. If the interest rates are lower and your rate of return is much higher in the markets, then perhaps you carry that debt and use the gains of the markets that you're getting to pay down some of that debt over time. So kind of do a bit of both. So I think it comes down to, when you ask a question like that, always what interest rates are doing, how interest rates are faring, what's going on, and the path of interest rates. We know interest rates are probably not going higher anytime soon. We've probably seen peak rates, and interest rates are on their way down. So that will also play a factor in answering that question. So with that, I want to say thank you to everybody who tuned into our show this afternoon. As always, thank you for taking the time. I want to say that we have a fantastic upcoming show in a couple of weeks on July the 24th, which is a Wednesday at 12 noon. We're actually going to have a panel of myself, Patty Lovett-Reed, Patricia Lovett-Reed, and Jonathan Chevreau. Patty Lovett-Reed, you remember her as the chief financial commentator for CTV News, and Jonathan Chevreau, who's been on our show many times. He is in the financial journalist area. He worked with Financial Post for many years as well, writing columns, and now Money Sense magazine. He is involved with that on a regular basis currently, and has a website, Findependence website, which you can go to as well. So going to have a panel. It's going to be a fantastic show. We're going to chat about the economy, investing, investment ideas. Promises to be a fantastic show, and I hope to see all of you, or to have all of you tune into our show in 2 weeks. But until then, happy investing.